If you're just getting started or new to investing, then this video is for you. By the end of this video, you will know what investing is, why people do it, and the initial steps you can take today to get started. Hi, my name is Milan, and I've been investing for the last 15 years. In this video, I'm going to teach you the lessons that I wish someone had taught me all those years ago. It would have helped me become a millionaire by today. I want you to invest in the safest and best way possible while also minimizing your tax burden. So let's get straight into it. I'm actually going to do this through a presentation because I find it will make it easier for me to explain exactly what to do. So first of all, what is investing and how can it help you build your financial future? Well, firstly, investing is the way in which we can make our money work for us. If you want to save your way to £1 million, it will take you an incredibly long time. But you can half the time, or more than half the time, if you invest your way there. Investing is the way to make money for you. For example, you can put your money away in a high interest savings account. Let's say you get 7% yield on that account. For every £1,000 you put in, a year later, you will get £7 back. That is making your money work for you. And that is exactly what we are trying to do over here by investing in the stock market. It is relatively low risk, but the rewards, especially when you wait 10, 20, even 30 years, can be monumental. And this is why we do it. Now, building up the habit of investing can also help you prioritize where you put your money and how you spend it. These are habits that can help make you a millionaire before you know it. So what is the stock market? A stock market is simply the platform for buying and selling shares of companies. For example, let's say you had a marketplace near you, which you walked to, and in that marketplace, there were a dozen different vendors. Each one might be more successful than the next. You decide that you want to buy a 10% share in one of these vendors. Well, this is what the stock market enables. It enables you to do that. Now, why would you want to purchase a part of a company? Put it this way, it is extremely difficult to start a company. It's even harder to start a company that becomes profitable. Most businesses fail within their first year. We're talking around 90% of businesses. It's incredibly difficult to start a company. If you put your own money into starting your own company, you've got a 90% chance of losing it, and potentially even more, especially if you take out loans. It's less risky to put money into a company that already has product market fit, that is already growing and acquiring more customers, and is increasing their revenue and profitability. It's less risky. Yeah, the gains you have might be less than with starting your own company, but you're much more likely to make money. And this is why we do it. It's also a more passive way of investing. Now, there are two major exchanges you need to know. One being the Nasdaq and one being the New York Stock Exchange. These are the two major US exchanges. And over on the other side, you've got the FTSE 100. Now, if you're looking at India, there are different exchanges there. In Europe, you've got multiple exchanges. Every country has different exchanges. But generally speaking, when I'm talking about investing here today, I'm referring to the major US exchanges like the New York Stock Exchange or the Nasdaq, or even ETFs, and I will get to that later on. Okay, so here's how buying shares works. You are simply buying or owning a piece of a company. Let's take the example of a house. I know a house isn't a company, but bear with me. Let's say this is a property that is on the market for £1 million, and whoever is staying there is renting. After accounting for all of the expenses and everything, you're left with a profit of £50,000 per year. This means that the property has a positive cash flow and is profitable, i.e. you are making money, you are making profits from this property. Well, let's say that you thought 2 or 3 or even 5 years from now, that property might be worth 1.3 million instead of 1 million. Well, what you might want to do is buy the property. But let's say you don't have £1 million. You could go to a bank and get a loan, get a mortgage. But another way of doing things, and this is how companies work, is by selling shares of the company. For example, if the property was broken up into 1 million shares, that would make each share of the property worth £1. So you've got 1 million shares worth £1, and you've got a property valued at £1 million. Now let's say you only had £1,000 to invest. You could buy 1,000 shares of the company for £1 each. After 3 years of waiting, that property might very well be valued at 1.2 million. In which case, the value of each share, assuming that there are no more additional shares in the property, will be worth $1.2. As a result of that, your shares have gone up by 20%. This is how people make money in the stock market. And it's how you can make money in the stock market, by selling shares once they have appreciated in value. Now, the other way of making money is through dividends. Let's say that the property made £50,000 in those next 12 months. £10,000 of that money was paid out to shareholders. You divide the 10,000 by the 1 million shares, and that is your dividend per share, whatever 10,000 divided by 1 million is. If you hold 1,000 shares of the company, multiply it by 1,000, and that is your total dividend. That is another way of making money, by investing in companies. So they can either pay dividends, or you sell when the value of that stock increases. Now, the next thing to understand, and this is where buying shares in a company or in an ETF differs from buying a property, and this is compound growth. It is a superpower that once you understand how it works, you will be excited to take advantage of. The best way I can explain compound growth is to show you. So let's say you have $1,000 and you put it into an S&P 500 ETF. Basically, it's a fund that will track the S&P 500. And let's say on average, it grows by 8% per year. Well, after 10 years, that $1,000 will be worth $2,158. You have more than doubled your money after 10 years. Try to get that in a 3% interest, high savings bank account. It's just not going to get there. Here's what I want you to understand, right? Every single year, the money is increasing by more and more. It's still increasing by 8%, but in terms of monetary value, it's increasing every single year. And now let me show you exactly how this works. So I have found this compound growth calculator online. I have added my initial investment, let's change this into dollars, of $1,000 with an interest rate of 8%. Now, 10 years later, so when you click calculate, you will see it is worth $2,158.92. But take a look at this. After 1 year, your interest is $80. That's 8% of $1,000. But after the second year, you've now got $86.40. After year 10, you're making almost $160 in interest, of 8% interest on that initial $1,000 investment. And now let's take this even further out. Instead of 10 years, let's look at 20 years. And this is how compound growth works, and it is why time in the market beats timing the market. Because after 20 years, the value will be worth $4,660.96, but that 8% interest is now worth $345.26. So this is how compound interest and compound growth works. It works like a snowball running down a hill. It builds and builds and builds, and it builds faster and faster over time as the money grows. This is compound interest, and this is key to understanding if you want to get excited about investing for your future. Now that we know how compound growth works, why should you choose index funds over individual stocks? Well, firstly, what are index funds? Index funds are simply in a way, they're a collection of stocks. For example, the S&P 500 is a collection of the top 500 companies, or the top 500 listed companies in the US. These are publicly listed companies. They're not privately held companies. They're companies that are listed on an exchange. So the S&P 500 is essentially a combination of these companies to give you one nice chart to follow. Now, an index fund tracks the S&P 500. That's all it does. So within the S&P 500, if there are changes, if companies are dropped out and new companies come in, the index fund will track those changes and basically emulate them. So your index fund essentially mirrors the S&P 500. That is what you wouldn't be investing in. And it's the same with the Nasdaq 100, but there are also other types of ETFs. You can have a global ETF, which basically tracks these different indexes like the FTSE 100, the S&P 500, and so on around the world, and bunches them up together. Now the question is, why would you want to choose an index fund over individual stocks and shares? Well, it's very difficult to select which stocks or shares will outperform the market for the next 10 years. And this is why for most of you, index funds is going to be the way to go. If you're busy, if you have a full-time job, and you simply want to invest and do not much else, not worry about it, then you shouldn't be thinking about investing in individual stocks. Not unless you're willing to spend the time learning about everything, about company valuations, about how to predict where the stock market might be going 12 months, 1 year, 2 years from now, or what the company might be doing 1 year, 2 years, 3 years from now. If you're not willing to invest all of that time doing that, the easiest thing you can do is to invest in an index fund. You put money in there every single month and you forget about it. That is the easiest thing you can do to achieve at least, I would say, 8% on average every single year. And I do want to say that even the best hedge funds can get things wrong sometimes. For example, Cathie Wood, who is a very well-known fund manager, has had really bad returns over the last few years compared to just putting your money in an S&P 500 index fund. You would have made more money doing that. So now you understand what investing is and why you should do it. You understand what you should invest in and why. But how do you make the most use of tax-efficient accounts? And why should you use these accounts? Well, let me give you an example. Here in the UK, if I invested in the S&P 500 through a normal investing account, let's say I put in £10,000 and the S&P 500 went up by 20%. That would give me a £2,000 increase in value of that investment. Let's say I sold it at the end of that 12-month period. So I locked in £2,000 of profit. Well, because I'm full-time employed, I would have to pay tax on that £2,000. Now, if I invested through a tax-efficient account here in the UK, it would be a stocks and shares ISA. In the US, it might be a Roth IRA. If I invested through a stocks and shares ISA, I would have to pay 0 interest on the money that I made on that investment. That is huge. And that is why I suggest you look into doing the same. It's very easy to complain that the rich don't pay their fair share of taxes. Well, you should be doing what they do. And using a Roth IRA or a stocks and shares ISA is a great way to reduce your tax burden. It's in fact a great way to pay no tax when you finally come to sell your investments. That is what you should be doing. Take advantage of it. It's there. It's not a secret. It's not illegal. It is literally there to be used. So use it. So if you're in the US, you can use a Roth IRA or a 401k. I would suggest using both and maximizing both as best as you can. If you're in the UK, use a stocks and shares ISA. You have up to 20 grand per year to invest in an ISA account. You can split that 20 grand through different accounts, and we have different ISA accounts here in the UK. So now I know all of this. How do you actually get to investing? Like, what do you do? Well, if you're over here in the UK, you can Google stocks and shares ISA, and you'll get a few results at the top. One of them being Trading 212, another one being Vanguard. Now, each of these will have their own associated fees, so I'd certainly look into them. But as of now, as of recording this video on Christmas Eve 2024, Trading 212 has lower charges for investing your money. So that's where I have personally invested my money with. And it's simple. You download the app for Trading 212 or Vanguard, you create an account, you follow the steps. You'll probably be asked to submit a picture of your ID. You can do that through your phone. And within 24 hours, if not immediately, you will have an account you can use. You deposit your money into that account, and you can then select the stocks that you want to invest in and how much money you want to invest in each of those companies or in those ETFs. It is that simple. If you're in the US, you can use Robinhood or Fidelity or even eToro, which we have here in the UK. So I would consider doing something similar if I were you. Now, one thing that you can also do or should be able to do with most of these platforms is to automate the process. For example, if you get paid on the last day of your month, then you can set up a process to automatically push money in to this account every single month. $100, it might be $200, doesn't matter how small it is, do it. You can then automatically have that money get invested into whatever ETF you choose to invest in. These platforms will allow you to do it. So you can literally set it up and forget about it. Literally forget about it for the next several years. It is as easy as that. You don't even need to think about doing it. That's the best part. It's all automatic. The money comes out of your account, and you can think of it like a savings account, or like a long-term savings account, I should say. And the reason why I mention long-term savings account is because you don't want to have to need this money within the next 12, 24, 48 months. You should be looking to lock this money away for at least 2 to 3 years, because anything can happen over the next 2 to 3 years, but it is all noise. Right, we could have a recession happen within the next 2 or 3 years. We don't know. It could happen. But 4, 5, 6, 7 years from now, it's much more probable that your money will be far higher than it is today. And that is why you have to have a long-term view. Okay, so to sum up, start with an affordable amount. Whether it's $50 a month, $100 a month, it doesn't really matter. Just get started. Get into that habit of investing. If you're worried or scared about investing, start small. It's fine. You have time. Focus on long-term growth. It isn't about short-term gains. It's not about doubling your money within a week or a month. Like, that's just very unlikely to happen. Focus on long-term results. You have to think like a business person. A business person isn't trying to create a multi-million-dollar company in a week or even a month or even a year. They have a long-term perspective and outlook of where they're heading for. That is the type of mindset you need to adopt. So adopt a long-term mindset, focus on long-term growth. Avoid emotional decisions. This is a big one, because when markets are rising, they're always going to be at all-time highs because they're going up. As a result of that, you will very likely see lots of content creators going, the markets are at all-time highs, they're going to crash. Look, the markets will go up over time because money is being printed by these governments, and a portion of that money is finding itself into assets like listed companies. Whenever things go up, they're almost always at all-time highs, like I said, and you will always find someone going, the market's about to crash. And every day, or if there's even a week where the market does fall for 5 days in a row, you will find more and more creators saying, get out, the market's about to crash. It's finally here, the big correction. And the reason why they do that is because fear sells. They know they're much more likely to get views if they keep saying the market will crash. And yeah, one day they will be right. But guess what? The market will crash. You put more money in, and the market will go to a new all-time high. It's inevitable. It's going to happen. So avoid decisions based on emotion like that. Finally, educate yourself consistently. Now, you don't have to keep learning and get drawn into everything and look at individual stocks and shares and so on, but it's a good idea to keep a track at least of maybe what is going on in the markets, or at the very least, the type of ETFs that you can invest in, from a global ETF to a Nasdaq 100 ETF to an S&P 500 ETF. It's always good to invest a little bit of time learning, especially when it is around growing your money. It's incredibly important to do so, at least in my opinion. But that is why creators like me exist, to help you go through those phases. So to sum up, number one, stay consistent and patient. Patience pays in this game. Number two, watch your money grow over time. And I'm talking over the course of a year, 2 years, 3 years, and so on. Number three, like, subscribe, and please share this video so others can learn from it. I'll see you on the next one.